A 1035 exchange is tax-free. In this episode, I'm going to address the question, can I replace an old life insurance policy with a new one tax-free? Now, the short answer is yes, but you must adhere to certain very critical rules. I'm Doug Andrew, and I've been a financial strategist for north of 46 years. I've helped many people analyze whether they should keep their existing insurance contracts or annuity contracts and maybe consider a new one, and when. By doing an in-depth analysis. We call these audits. Many times we have audited our own clients' insurance policies annually. I would recommend at least every 5 years that you have your insurance policy audited, maybe by someone other than the agent who issued it in the first place if you want to get a second opinion. This is what's critical. Whenever you do a 1035 exchange, you want to preserve the tax-free accumulation, any ground that you have gained in the existing old policy, and make sure it rolls over, it converts, it transfers to the new policy. Section 1035 of the Internal Revenue Code with insurance is very much like 1031 exchanges in real estate, where you sell a like property of real estate, you buy a new one of like property, and you can transfer the capital gain. You don't have to pay the capital gain tax. It moves and you don't have to pay that tax because it transfers into the new property. In the same fashion, a life insurance policy can be exchanged for a like type of instrument, another life insurance policy. It can go from whole life to universal life, or variable life to indexed universal life. You cannot take it from an annuity to insurance because that's not a like instrument. Now, there are some other rules that apply when you do this, because if you're going to exchange it, you're trying to preserve any accumulation, any tax-free gain, so you don't trigger unnecessary tax when you do this. Because here is what some agents don't realize, and they trigger unnecessary tax when they say, oh, just cancel that policy and take out this new one. What do I mean by taking the money from one policy to another and not touching it? See, if you were to surrender that policy or just cancel it, and you were to take receipt in a check and put it in your bank account or whatever, or even if you endorsed the back of it and sent it to the new insurance company, the IRS can come in and say, no, you took receipt of that. You're going to have to pay tax on any gain if there was a gain. So let's say for the 5, 10, 15, 20 years or more that maybe you owned this old policy, you paid premiums of $500,000. And if it had a gain, if it's worth $700,000 or $800,000 or $1 million, if you took receipt of that, you'd have to pay tax on the gain over and above your basis that you put into that, but not if you do a 1035 exchange. That means the cash value just simply is transferred from this insurance company over to the new insurance company in that policy. You don't touch the money. That is done between insurance companies. They receive 1035 exchange requests all the time. They know how to do this, and therefore you do not have to pay unnecessary tax, and all any ground that you gained here tax-free transfers over to the new one, and the basis that you put in and all of the room that you already used with the various tax citations rolls into the new policy. So let me share with you one of the rules that many insurance agents don't stop to consider. So let me use an example that you have an old insurance policy, and maybe you designed it originally primarily for death benefit, but you wanted to use it for income, emergencies, or what have you. But then you learned about how to max fund an indexed universal life, and your old policy has only been performing at 6, 7, or 8%, or maybe it's a whole life policy and the dividend rates and so forth have only been 6 or 7%. And so you're only netting maybe 4 or 5% at best. You learn that a maximum funded indexed universal life insurance policy can earn 11 and net 10, which is what I've averaged for more than 25 years now. So you want to have the newer policy because you can participate when the market does well, not lose when the market goes down. That's what indexing does. I have other episodes that explains that. So you're trying to improve the liquidity of your money, the safety and the rate of return, so that the new one, when it has $1 million of cash value, can generate more like $100,000 a year of tax-free income for as long as you live, instead of the old policy. If it grew to $1 million, if it grows to $1 million, at best it might only generate $40,000 a year of tax-free income. What would you rather have, $40,000 or $100,000? Hello? So that warrants a 1035 exchange. Now, you can just take the existing cash values of the old policy and put them into the new one. But then, if you want to continue to maximum fund, put new money into the new one for another 5 or 10 years. You don't have to, but if you wanted to, you would have to start over with the TAMRA law on much of the new money, because you have to wait 5 years before you meet the TAMRA qualification with universal life. With whole life, it's called 7-pay. It takes 7 years. So let's say the old policy, you could have put in a maximum amount of, let's say, $500,000, but you only put in $200,000. You have $300,000 of room that you never used. Well, if you have $300,000 or more that you want to put into a new one, it would behoove you to put it in the old one first. Why? People say, well, why would I do that? It's underperforming. Because if you put the $300,000 in that you could have put in, or whatever the amount is, and a professional can help you calculate this, you put it in the old one and immediately do a 1035 within days or a month over to the new one, you hit the ground running. Now the new one has way more money in it that was grandfathered under the old policy's limits, and you hit the ground running. And if you have any room left, golly, you could probably totally maximum fund that in 1 or 2 more years instead of waiting maybe 4 or 5 years to do it. There's a lot of licensed insurance agents that do not know about what I just explained. So when you ask the question, can I exchange, can I replace, trade out an old policy for a new one? Yes. Under a 1035, it's totally tax-free. But there's more to consider than just can you do it. You want to analyze, is it wise? And how much room do I have that I can 1035 by maximum funding maybe the old one before I transfer the money to the new one? It makes all the difference in the world as far as your growth and how fast you can start accessing money totally tax-free. For this very reason, I have authored many books that teach and educate people who want to learn. And I've published 11 so far. I'm working on my 12th one. Book number 11 has been a bestseller right off the bat, and I would love to gift you a free copy of this book. It's called The Laser Fund. LASER is an acronym that stands for Liquid Asset Safely Earning Returns. Whenever you do a 1035 exchange, you want to increase the liquidity, safety, and rate of return and the tax benefits on the new policy, and that's what I've been explaining. If you want to learn about this, this book retails for $20, but I will gift you one free. You just pay $5.95 shipping and handling, and this 300-page book is yours. It's actually got 14 chapters on this side that have charts and graphs, but you flip the book over, this side has 12 chapters with 62 actual client stories. And so to get your free copy, you can claim it by going to Laser Fund, L-A-S-E-R, laserfund.com. You pay $5.95 shipping and handling. I'll send one out to you. There's also options if you like to listen and learn or watch and learn for audio and video content that will help you understand this dynamic concept.